Our guest today at the Financial Literacy Talk is Arie Kapteyn from the RAND Corporation. Welcome, Arie.
Thank you. Good to be here.
So we'll be talking today about when to claim Social Security benefit.
Yes.
Can you describe the objective of your project?
For a start, I want to make clear that the Social Security claiming decision, when people start getting Social Security, which they can between 62 and 70, is one of the most important financial decisions pretty much anyone makes during their lifetime. It's definitely up there with, for example, buying a house, what mortgage to take. It's a decision that really determines largely how well you will be off for the rest of your life. And if you think of current life expectancy, someone who's 65 or 66 can expect to live another 20, 25, 30 years. And if you look at the effect of that, for example, if someone, let's say that someone is 62 and that person would expect to get about $1,000 per month in benefit. If that person waits until 70, the benefit goes up to more than $1,700. Of course, by doing that, you also have a number of years that you don't get anything, but if you think you'll live long, you will really have a lot more money at later ages. So it's a very complicated decision, because on the one hand, you must say, well, if I claim later, all these years that I haven't gotten anything, I'm missing that. On the other hand, if I claim earlier, I'll have money earlier, but then I won't have as much when I grow really old. So it's a very complicated decision. It's also a decision that we have no experience with. It's a one-in-a-lifetime decision. It's not like a car. If you made a mistake the previous car, maybe this time you'll do better. You're only 65 or 60 or 70 only once. So it's a very important decision, and it's a complicated decision. So then the question is, how do people make these decisions, and how can we help them? And of course, the way we help people making decisions is by giving them advice. We talk about the effects. If you do this, this happens. If you do that, that happens. And typically that advice has to be simple. But simplifying a complicated decision in itself has a certain risk, because by simplifying you may sort of stress one thing, you may stress the other thing. And so what we look at in our paper is how that matters. So we call it framing. You can frame an advice in different ways. You can frame the decision in different ways. And what we find is that the way we tell the story about the decision that people have to make, has quite a bit of an effect on what people then say they'll do. So you can move the date at which they want to start receiving Social Security benefits easily by a couple of years, only by telling a different story. So nothing changes in the facts, nothing changes in the numbers, nothing changes in anything material except the story we tell them. And so first of all, that's important. Secondly, it's also a little scary. It's bad news in some ways, because it tells you that people don't quite understand what the decision is about. Because if I really understand the decision, then I'm not going to be swayed by the way you tell me the story. It can just be, you know, whatever you tell me. It's like I buy a car, I know everything about cars. Whatever the car salesman is going to tell me, it's really not going to make much of a difference. If I buy a car and I don't understand any of it, then what the car salesman is going to tell me is making a difference. So what we see here, that many people apparently find it very difficult to really understand what a decision is about. And what makes it more dramatic is the fact that there is variation. So people who are financial literate, people who understand money, who have actually answered questions about money in earlier tests really well, these people don't get influenced all that much, because these people, they understand the problem, but then the people who are influenced are the people who are not doing very well on these financial literacy tests. So they're the ones who have trouble understanding compound interest or inflation or risk diversification. So these are the people who are influenced a lot more. So these are the people who probably don't have as much understanding of what they're doing. The unfortunate thing is these are also the vulnerable people. These are, for example, most likely to be women. Women are a vulnerable group in old age, because women are often widows, women often have low income in old age. These are often people with lower education. People with lower education have lower income during their lifetime, they have lower Social Security, so they're more likely also to be vulnerable in old age. People who have credit card debt are more likely to be influenced. Well, people with credit card debt are often people who have a little harder time managing their money. So you see that those people who have a harder time managing their money are more likely to have lower income in the first place, are also more likely to make mistakes in making these decisions. So there is an effect of how we tell the story, and the effect is biggest for those groups that are most vulnerable.
It seems that, just the framing of this decision or this question affect how people make decision. So
Right.
it is striking how easy it is to influence decision making.
Yeah, and I think we have known that, of course, in general terms. We know this from other domains, health decision making, other important decisions that people make. People find it often hard to understand exactly what they're doing, and they go by cues that they pick up of sort of what they think is then the best way of doing it. And you probably want to talk about policy at some point, but because the issue now is what you're going to do with that, right? Because now we see that people are influenced. We see they don't really always know what they're doing, and now you have to think, what are we going to do with that information?
I want to definitely talk about policy.
Mm-hmm.
I mean, what are the implications of your research for policymakers?
So one thing is that, given the finding that if people are more financial literate, they're less likely to be influenced and more likely to understand the question. The first thing you would think is that financial education is a good idea in any case. And we knew that in some ways, because it's always good if people are better informed, if they better understand what's going on. But this just makes sort of an extra case for that if you want people to make good decisions, particularly in this case, one way to help them is just make sure that they have more financial education, because then at least they have a better chance of understanding what the decision is really about. The second thing is that, apart from that, there is a certain normative aspect to it. I mean, we sort of know that certain decisions are better than other ones. So, or maybe phrased differently, we know that certain ways of thinking about it are better than different ways of thinking about it. So we can also help, for example, financial advisors explaining the decision in ways that are probably a little closer to the interest of the client. We know from other research that, for example, Matthew Greenwald and Associates have done, that also financial advisors often have a pretty superficial understanding of really what it means to claim Social Security benefits and what the mechanism is and what the effects is of different choices. So at least one of them is to inform financial advisors and help them better explain the decision to their clients. But I think more generally there is a lot more work to be done in thinking about how to explain the decision and emphasize the things that are most important. And there is a tendency sometimes by the way this is being presented that people are triggered by aspects that are maybe not the most important one. And I think the most obvious one of that is what's called the insurance value of Social Security. And what's meant by Social Security, value of Social Security, is that it is an insurance against living long. And people don't always realize that, because sometimes people talk about Social Security as gambling with death, because they say, I get Social Security, and if I die after 5 years, the money is gone. So that's, and of course, strictly speaking, that's a correct statement. But what they forget is that there is another risk, which is if you claim early, you have a low Social Security level, you don't have a lot of other income, and now you live to be 95, you have a really long period with really low income. And so often this is called the long life risk. And somehow people are more triggered by the risk of leaving money behind and dying early than living long and being poor. And most economists would say, if you think about it, you really should think harder about the long life risk than about the other risk. And of course there are ways to also do something about that.
So what do you plan to do next? There seems to be so much important research to do in this field.
Yeah, so what we had hoped to do, and I still hope it's possible at some point, is a natural next step is to do a field experiment. Because the experiment we have done is in the American Life Panel, so we ask people questions. These are hypothetical choices. We give them different scenarios and say, what would you do? And ideally what you would do is a field experiment, hopefully in collaboration with Social Security Administration, and say, well, how about if we think about the way information is presented in the field offices? And let's see whether you can optimize the way information is presented. I mean, that will be an ideal setup. Short of that, I think there is still a fair amount of work that we can do, because in a sort of theoretical framework, what you would like to do is help people make decisions that are optimal for them. And the easiest way is to just say, well, here's a decision, you know is best for you, and that's it. But we know that that's not good enough. We know that people may not always have a good understanding what's good for them. So one part of research that you can do is, on the one hand, try to learn more about really what they want. For example, are they really are they afraid of running out of money? Do they think they'll live long or short? And then use that as input in the advice. So then at least you can say, well, if you really think that you're going to live until 95, that should have a different implication than when you think, well, you know, my family, no one ever lived very long, so maybe I should take a different approach. So we can help people in guiding them a little bit in a direction that may be better for them just by asking them more questions.
As you said, when to claim Social Security benefit is so important and is so worrisome that people can so easily be influenced by the way we present this decision, and I so much look forward to seeing more of your work.
Thank you very much.